Coming up on the SBS On the Money podcast, the Australian share market down today by 0.8%, but gold is back at a record level. It's been a tumultuous week, so what is next? That's coming up. Hi everyone, it's your daily 10-minute business and finance news wrap for this Friday, the 11th of April 2025. The Australian share market fell today by 0.8% on the S&P ASX 200 to 7,643. It's been a very volatile, only in the scheme of things, by 3.5% since the day Donald Trump announced his so-called reciprocal tariffs. Still, what's next? For that and more, I spoke with Lochlan Halloway, an equity strategist at Morningstar.
Let's talk about the relief rally yesterday just quickly, because I think that's a bit of important context. The market was reprieved. There was a bit of reprieve there after a fairly extended period of uncertainty, and Donald Trump's initial I suppose the initial idea that he might be willing to roll back or to temper some of these tariffs lit a fire under markets and saw them claw back a lot of the loss that's in past days. I suppose, though, today and why the market might have slowed off a bit is that it's probably, we're still looking around and seeing a significantly changed tariff environment from what we saw a couple of weeks ago. Yes, there's more willingness now perhaps to negotiate, and some of the most punitive tariffs have been walked back, at least for now. But we're still in a trade environment that we haven't really seen in the US for about a century. In terms of the magnitude now of tariffs on goods coming into the US, this is a massive shift. Yes, not as bad as yesterday, but it's still pretty serious, and that has macro implications and certainly sentiment implications across the market. So, look, volatility is probably here to stay for some time yet.
Given the tumultuous couple of weeks, right, how are you feeling as an investor?
Look, I mean, it's never comfortable to see your portfolio sustaining heavy losses. I think that's true regardless of what you view as on the market. Look, what I'd say, though, is perhaps to put a bit more of a silver lining on it, is that when you do have these sell downs, that can present opportunities for the patient investor. A lot of the stocks that we cover now are screening as much more attractively priced than they were even a couple of weeks ago. We're seeing the ASX on average at a pretty steep discount of about 10%, and that was a premium of 10% at the start of the year. So, look, if the market was charging ahead all the time and equities are always expensive, there wouldn't be opportunities. This is the one part about these sell downs. If you have the patience and the mettle to do it, you can find some value on the ASX.
So what do you think really has been driving it? Is it fear? I mean, is it logical? How's the market fundamentally looking?
Look, I think there's a little bit of both. I mean, to my first point about, how much of a sharp change this is to US trade settings, we have to sort of keep that in mind, that we haven't been here in a very, very long time. The common macro assumptions we make are probably not all that well suited to assess how this sort of change could impact global trade, the US economy and our economy. We don't even know how long they're going to stick around for. That's the other factor too. Even if if they're in place, that's one thing, but these could be walked back in the very near term. They could be sustained, they could be escalated. So that uncertainty piece and the potential macro effects, if these tariffs are maintained, probably is to some degree justifiable. But the broad-based sell downs, the blanket selling of everything we've seen in the last couple of days is probably not justified. I mean, you can see when, gold's coming off during a market panic, that investors are just flying to liquidity. They don't, they just want to hold cash. Generally speaking, in those kinds of dislocations, that's where it becomes unwarranted, becomes unnecessary. And again, to my earlier point, if you're a patient investor and you're willing to ride it out, that's where the opportunities lie.
How do you see the US economy now, given a lot of this fear and uncertainty stems from the world's biggest economy and whether or not it falls into a potential recession? We saw some inflation numbers come out overnight, cooled to a 6-month low in March, but it is expected to rise, though, with these tariffs.
Yeah, look, you're right there. And I mean, obviously, the inflation print, I suppose, in and of itself was generally positive news, but it's the outlook that really matters. And we've become quite a bit more pessimistic on US growth and inflation over the past few days. Again, we've got to sort of call out this is contingent on these tariffs staying around. If they disappear in the next week, well, then the outlook changes again, of course. So really just sort of rolling with the punches here as it changes. But if we assume they are maintained, at the moment we are assuming they will be maintained largely, at least for the rest of the year, then we're going to see, slowdown in US growth. We're going to see a higher US inflation. At the moment, we're expecting something like a 40% chance of a US recession. It's not our base case, but the chance of it occurring, in our opinion, has increased materially in the last few weeks.
What kind of an influence has all of this had on interest rate markets now?
Yeah, they've been swinging around almost as wildly as equities have, really. I mean, we've had, a big sort of reduction in US Treasury yields at the start of the tariff talk when there were concerns about US growth and sort of safe haven flight to safety behavior, and then that started to unwind. There were concerns around the US fiscal position, geopolitics, the credibility of the US as the global reserve currency, and so yields have then started to rise again, which is quite unusual. I mean, in these very volatile times, generally the US dollar, US Treasuries are seen as safe haven assets. That's kind of bucked that trend recently, which I think has gotten the US and investors generally rather jittery, and probably played into Trump's willingness to start to walk things back a little bit. Rates in terms of the outlook, we're now pricing in, the market's pricing in, much more significant cuts from the Fed. And domestically, I think we're looking, last time I checked, at potentially up to 5 cuts this year at current market pricing. That's a big swing. Only a couple of weeks ago, it was 3. So obviously concerns about the global growth outlook and the implications for our economy are weighing on the investors' outlook, and certainly pulling back expectations or bringing further rate cuts into the picture.
Like you mentioned earlier, it's all kind of asset classes that were kind of thrown out with bathwater earlier in the week. One of them was gold, but today it hit a record high despite all this volatility. How do you see it now? And the fact that it's now back to its role as a safe haven, right? And that there's a bit more logic. Does it perhaps suggest that the extreme volatility may be coming to an end?
Look, at least in the short term, and who knows what's going to happen tomorrow. If we've got so many uncertainties at this point about not only how the US president will react, but also how other global leaders might react and retaliate. So, it could absolutely be back on the cards that we see another big bout of volatility. We can't rule it out, but it's probably, contextualizing what happened today with gold, you'd think it probably has, resumed its place as the safe haven asset. And, when you've got concerns around geopolitics, and things like the US fiscal position, I imagine some investors see gold as quite attractive right now, though I'll point out, at least on our ASX-listed gold mining coverage, we're starting to see a lot of those companies as quite expensive golds at abnormally high levels. We don't think that's in the long run sustainable. So generally speaking, we see gold miners as overvalued, but you could rationalize why investors were piling back into the asset class today.
And what's your take on these swings we've also seen in the currency markets? The Australian dollars are recovered, but I also think that the US dollar is really weakening at the moment too. The US dollar index also reaching around 100. Is that right?
Yeah, it's been quite bizarre, the price action. When we look at, especially comparing the US dollar index to, long-dated US Treasury yields, they're kind of moving in opposite directions. Generally speaking, those are quite closely correlated assets because as Treasury yields rise, the US becomes a more attractive place for bond investors to move into to capture higher yields, and that generally puts upward pressure on the US dollar. But that's flipped around the other way now. US Treasury yields are rising, but the dollar has weakened. Again, it probably goes back to that point earlier about some investors questioning how safe the US really is right now. That's not our view. We're not saying that investors should be flooding out of US equities. We see them as very attractively priced right now. But obviously some investors are quite skittish and there is a lot of uncertainty around, and they're pulling out of what are traditionally considered safe haven assets like US Treasuries.
So when we look at shares now into the new week, what happens in the equities market, right? What's the next key driver? What are you looking to?
Yeah, look, I think what every investor is probably looking to now is a bit of stability and a bit of assuredness on the trade front. Regardless of what way that all falls out, what is actually going to be happening, what sort of trade world are we moving into? As I said earlier, we're in highly unusual times for US tariffs. We haven't seen this since, back to really in the Great Depression era. So we need some more clarity around where that's going. That's probably, in the next couple of months, hopefully that will become clear what's happening on that front. we are, though, in terms of, well, what should you do? You know, where are shares heading, so to speak? I mean, who knows in the short term, but generally speaking, we're seeing a lot of value across our US coverage. We see it as significantly undervalued. And if you are willing to, you know, ride out the turbulence, and there will be more turbulence, you can pick up, you know, a lot of names, quality, you know, high quality companies, defensive companies at attractive prices. And look, we've been through big crashes before. We've had a pandemic, and we had the post-pandemic crash, we've had a global financial crisis, we've had wars, we've had depressions. The long-term trend for equities has been favorable, and if you have the mettle to try and dip the toe in these dislocated, volatile down markets, generally speaking, you can do well as an investor.
That is Lochlan Halloway there from Morningstar.
This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.